Thanks, Tanya. I'll ask my panel to introduce themselves. We have a lot of great, rich, and diverse expertise here to address this topic: history, present, and future of emerging markets. With me is Janusz Heath from Capital Dynamics and Paul Boynton from Old Mutual. Why don't I hand it over to Janusz and then to Paul to introduce themselves, please, and then I'll come in with a poll question.
Good morning and good afternoon, wherever you are. I'm Janusz Heath of Capital Dynamics. Just briefly on us, we're a private asset manager, managing institutional and high net worth money, focused on primaries, secondaries, co-investment, and credit, very much in the middle market space. And then on the other side, we're a major clean energy investor as a direct investor, but that's focused solely on the developed economies, North America and Europe. So our emerging markets activity is driven out of our offices in Tokyo, Hong Kong, and Seoul. Over to Old Mutual. I feel I should be old, actually.
Yeah, Janusz, a bit of a competition there, maybe. But hi, welcome everybody. Paul Boynton here from Old Mutual Alternative Investments. We're an Africa-based manager. We are both an LP and a GP principally in Africa. We have 4 different verticals where we're involved on the African continent. The first is infrastructure, where we run a Pan-African franchise under the brand name AIM, African Infrastructure Investment Managers. We have a private equity growth and buyout strategy in Southern Africa. We have what we call an impact team, focusing on investing in assets that have a social objective as well as a financial return objective. And in that space, we're invested in affordable housing, affordable education, and retirement accommodation. And finally, as a GP, we're involved in agriculture, also on a Pan-African basis, where we are investing in primary agriculture effectively. We also run a fund-of-fund program across Africa, and we also have a global element to that, where we are investing in developed markets and other emerging markets outside of Africa. So that's a wrap, Vikram. Thanks.
Thanks, Paul. And to round things off, Morgan Stanley Alternative Investment Partners is a investor in private equity GPs around the world, as LPs, as co-investors, as liquidity solutions providers, and seeding and staking solutions as well. So we do the full spectrum in partnership with what we consider great GPs around the world. The emerging markets program is something I lead, but like Janusz, we also have a climate investing program, which is global, and I cover that as well in my other hat as the head of impact investing. A lot of what we do in emerging markets correlates very nicely with what we look to do in impact, the natural outcome of our investment thesis. So with that, I'm going to ask the audience a polling question. As you would expect for a panel like this, it is, how do you feel about investing in emerging markets at this time? Your options are A, extremely confident, B, optimistic, C, unsure, and D, not confident at all. So those are your poll questions, and we'll check in at the end of the session to see, what you thought then, and hopefully we've added to your insights during the process to maybe keep you where you are or move you in either direction. So with that, while we have you on the screen, Paul, let's get into where you stand on this big macro question. What's your temperature check on the state of emerging market investing at this point?
Look, it's a very uncertain time at the moment. What we can share is our experience in Africa to date through COVID. Touch wood, the impact on Africa as a continent has been, from a health point of view, somewhat benign in comparison to the rest of the world. I think the University of Washington, who run predictions and they're the kind of source of all the data that the US government is using in terms of analyzing their outcome, have forecast that US fatalities from COVID through March next year are likely to come in at about 450,000 in aggregate. Whereas if you look at Africa, their projections over the same time period, and obviously Africa is a continent of over 1 billion people, is just over 50,000, of which half of the fatalities are expected to be in South Africa. So if you look at, South Africa is rather modest in global context, but the rest of Africa, the actual health impact of COVID on what's happened has been, very undramatic in comparison to elsewhere in the world. Obviously the economic impact is different because, Africa is part of global supply chains, and, dislocation elsewhere has had an impact across Africa in parts, particularly, for instance, the tourism industry, travel, that kind of space. But what we are seeing is China come back strongly. Last quarter GDP growth in China was a very compelling number. Things are coming back quickly there. Agriculture has prospered quite well through this period in Africa with our exposure. And so we think that emerging markets are potentially well positioned to come back. Maybe Janusz, do you want to comment further on that?
I think we're at quite an interesting inflection point, and we're not actually going to know the answer till we look back on it. But, as you mentioned, China is now essentially the only major economy in the world that's back in GDP growth. And the developed economies, however effective the vaccine is, are going to take some years to gather momentum again. And in that context, bearing in mind a lot of the emerging economies were not in a position to provide aid in the way the developed economies have, they've sort of traded on, irrespective of mortality and COVID. And, I make this comment in the context that our business is solely about one thing: identifying managers. If you haven't got a manager, it's not the economy that's going to make you money, it's the manager. I think people need to look very carefully at where the next 50 years are going to be in the context of emerging markets. One of the things that surprised me, as a global investor with investors that come from around the world, is how wedded, in fact, more so before COVID, investors were really very lukewarm about emerging markets. They're more lukewarm than they'd been for quite a long time. And they seem to be even more lukewarm, if one can be more lukewarm, less lukewarm, cooler, to the emerging markets now. And the behavior, I've been in this industry nearly 40 years, said in numerous recessions, and this is very different. But every time we see this, we see major economies, US investors going back to the dollar. They shrink back into their markets and they're late to come in. If we're right about emerging markets, if we're right that we're seeing great managers emerge from emerging markets over the next 50 years, that's a strategy. It's not about diversification. It's about identifying the next generation of great managers and economies that are going to produce, hopefully, good returns backing them. So I think there could be quite an interesting economic inflection point here where the emerging markets get back into the saddle much faster and with much healthier horses than perhaps the developed economies, where we crawl onto an old croc that finds it a bit difficult to get into a trot, let alone a gallop.
So what you're saying is emerging markets are open because they have no choice but to be open, and that is going to make a difference in the foreseeable future. Now, going one level down, if we were to look at individual regions, you were born in India, you have a Polish name, and I understand your family in Africa. So where in the spectrum of emerging markets do you see sort of green shoots or a silver lining, whatever metaphor you want.
That's the danger of telling people your background, isn't it? Look, the one thing I've learned in this business is it's not where I think people should go. If only my investors listen to me. My role is to listen to where my investors want to go. And I think there's opportunity in every economy. And indeed, one of the things we've learned from developed economies post-recession is that's where some of the best returns have been. Pricing's got a bit better, opportunities there, great managers can accelerate businesses. Quite clearly, China is a huge economy. And we're already seeing coming out of China global leaders like Alibaba. Exceptionally large businesses, which are then spawning exceptionally large businesses. So clearly you cannot ignore the opportunities that are coming out of China. There's a lot of geopolitical noise, about Unja, all this stuff. And I am a bit concerned that as a consequence of that, and this is a political statement, that politicians are ignoring the politics because the economic opportunity is so large, and that gives me some concern, because I think it's a bad practice just to turn a blind eye to what's going on. But all of these economies, you mentioned Africa. Africa is probably going to have 2.3 billion population within 30, 40 years. You think about the demographics. You've got, again, an industrial revolution sort of having in Africa from the country to the cities. We saw that in China. There's opportunity in all of them. The question is, are there GPs who understand how to make money in that opportunity in all of them? And the answer is, in some more than others. And the question is, can you find them, one? And then if they're that good, can you get access to them in 10 years' time when they've proved to be that good?
Great. I will ask Paul, who obviously has a Africa perspective, but I understand as an LP is globally diversified across its investment. So what are people not necessarily getting about the Africa story and maybe the broader EM story?
Look, I think Africa has, from a PE perspective, has suffered from two issues historically. One is poor returns. So the actual experience to date in Africa broadly across the PE space has been indifferent. And secondly, there's a scale issue where large LPs are not able to make a reasonable investment into an African GP because the GP is too small. So for dint of that, they haven't moved there. What I do think is that that is changing going forward. I think the macro picture on Africa as a whole, in terms of an emerging broad economy over time, is very solidly positioned over the next decade. The demographic argument which Janusz raised is very compelling. Half of the growth in the global population over the next 30 years will be in Africa. Africa is 20% of the global landmass. It's home to 30% broadly of the mineral endowment across the planet. It's home to 60% of the remaining uncultivated arable land. And with improving governance broadly on a longer term basis across Africa, I think the prospects for that opportunity set to be turned to account over the next decade are quite strong. Looking elsewhere within emerging markets, we have favored Southeast Asia as sort of a growth locomotive globally. So that would be our kind of analysis on where growth lies forward. I mean, one of the interesting things, The Economist runs every year an analysis of the top 10 economies historically and prospectively over the last decade or over the decade forward in terms of economic growth. And invariably, 5 of them are always from Africa, albeit, obviously very small economies, but nevertheless, and not necessarily consistent either. So they do change from year to year. And last year, I think Ethiopia was vying with India for the top spot in terms of forward, projections for the decade ahead. That hasn't unraveled well in Ethiopia's case at the moment, but nevertheless, sitting there with predicted growth rates of 7 or 8%, I think the Ivory Coast is still, looking at a projected growth rate over the next decade of north of 7%. So there are pockets of extraordinary growth, available across Africa.
So,
if I
this is please, Janusz.
We're back to where the opportunities. I also think the real question is, how do you convince investors
that was going to be my follow-up.
These are markets that they really should spend a bit more time on? And obviously, in our business, the answer is returns. But one of the things that I think has become evident in maybe in the last 5 years in particular is politics have always played a big bit in people's perception of emerging markets, but I think they've become even more of what I call the CNN effect. So you look at many of the economies, in India, Modi's conduct in some areas starts to give people discomfort because of the religious divides. You have Orban in Hungary and Kaczynski in Poland. They're both in the papers yesterday talking about, being difficult in the European Union. Who am I to talk as a Brit? But let's, you have Brazil, you have the Philippines. Who would ever have thought that 2 out of the last 3 elections in Kenya would have been difficult rather than smooth and democratic? So you've got all that noise, and ironically, you've got a somewhat embarrassing transition of power in America going on as well. So the political noise, I think, has acted as an extra headwind to people because Ethiopia going the right way, huge education, a lot of movement, then suddenly there's a war there. So I think that it used to be just currency and a bit of corruption. Now I think it's a lot more currency and Turkey. What's the political surprise we're going to have here?
Investor interest, as we discussed in the prep call, it's a question of 3 steps forward and 2 steps back. People are enthusiastic, they buy the story, they come in. They don't see the returns. They spend an awful lot of time convincing people it's a good thing to do. And then, as you say, there's the CNN effect that compounds things. What does it take to change things? I mean, with the magic wand, we can't wish these problems away. But does it take one emerging markets company listing on NASDAQ with sort of unicorn status or something like that to get people's attention back to a sensible EM allocation?
I think it's liquidity always, isn't it? I mean, if I was to point at a weakness in the Chinese private equity market, hasn't really yet got a trade sale market going, as you would see in a developed private equity market. Having been in this industry nearly 40 years from the beginning in the UK, I'm a great believer that the cycle, Europe followed America, which followed UK followed America, which then Europe followed UK, which followed it. And movement of buyout market, although now we're seeing growth buyout. I think it's about return and liquidity at the end of the day, confidence that you have a return and liquidity in those markets. Then investors will step back into them with a little more enthusiasm. That would be my view. Paul?
Yeah, I think that's right, and I also think these are evolving ecosystems, and what you are seeing is new managers coming in with more focused, targeted spaces that they're concentrating on, and turning to Janus's point, in a bad environment, you can still find someone making money if they focused on the right things and are executing diligently and well, and managing risk well. And you're seeing more and more evidence of some of these managers getting this kind of thing right. So the broader ecosystem getting better, and I think Janus's point is very important, that exit is an improving market for exit across emerging markets. Continuously kind of improving market for exits is making prospects there better, incrementally, and then this better execution. So I think that there's some tailwinds to what can happen in these spaces. And then if you're getting managers more diligently and more competently executing, then you should be pushing returns up solidly from those kind of folk.
I think also thinking about it, makeup of teams. One of the things personally I find interesting, attractive about African teams is diaspora, which I find quite interesting. A lot of the African teams are made up of guys and girls, gone to the US or France or Europe to be educated, maybe worked for McKinsey's, then TPG or KKR or whoever it is. And they brought those values back in. But because they came home for holidays, etc., and their family was still based there, they've got all that network. And our business is about network. They understand business. They're not, my mother left after the war. I ran one of the mass privatization funds in Poland. I didn't speak Polish when I went back to Poland. I was getting to grips with something which was in my blood, but certainly took quite a lot of understanding. They've got it. They know it. Their third cousin is now running the sugar mill. I think that diaspora, that real diaspora bit, understanding the values that we cherish as institutional investors, but how business is done and has to be done in those economies to build. And the ambition to build global businesses is quite interesting, particularly, actually, I found that in Africa. I don't know, Paul, that's a romantic view from a foreigner.
No, that resonates with me completely. Remittances, which people, out of Africa, working outside of Africa, from Africa, working outside of Africa, are sending back to the African continent, now exceed foreign direct investment. So it's a big amount of capital that's being sort of played back. And the other thing, I was watching CNN yesterday. A young fellow has just been elected as an MP in New Zealand, who's an Eritrean refugee. And his maiden speech in the New Zealand Parliament was everyone was crying, because it was just so profoundly demonstrative of the capacity of the human condition to survive extraordinary odds. And he survived and was a refugee and sent to New Zealand, and he's made a real go of it there and become a member of Parliament, and everyone was applauding him hugely. And that is one of the big opportunities left in emerging markets, is the capacity of the people there. And I know Steve Jobs said about India, when Apple opened up in India, they thought that the huge opportunity in India was the market, but actually the huge opportunity for them turned out to be the people who've played back into the Apple ecosystem with extraordinary talent. So emerging markets is replete with untapped human capital, and that's what investors need to be looking for and trying to turn to account.
And I think back to your question, I all my life, the thing I've learned is people make money. It's great to have positive GDP growth. We clearly haven't got that in many places in the world now. It's much easier to build a business when the wind is in your sails rather than in front of your sails. But the number of good people I've seen take a bad business and make it a good business, and the number of bad people I've seen take a good business and make it, our business is backing people and their judgment, particularly if you're in the primary business, and their judgment, reading the timescale and the opportunities. So the investment decision that we take within our investment committee for an investment in India or China or Japan or France or Poland or England is fundamentally the same. You know, are these good people? Have they got the right value system? And have they got the right skill base and just that little bit of gold dust? And if there's luck on top of that, as Napoleon said, give me a lucky general, that's great. But, you know, it's...
That is a very good point. Look, gold dust and luck. But I think, you know, I've always held that you have to have all the smarts you need to be a good GP in an emerging market as you do in a developed market. But additionally, and this is the point both of you raised, you need a lot of resilience. You need your 100-day plan stops working on day 20. You need a plan B and a plan C and a plan D. And I think that's the quality, I think all three of us agree, makes the difference even in a lousy market. So taking stock now, I've got structural argument for long-term investment in emerging markets. That's where the demographic growth is. That's where all the things you alluded to, Paul, in terms of arable land and so on. I've got the CNN noise factor that's distorting things. And then we're coming down to people, and we're talking skill sets, and we're talking about, you know, the ability to find hidden gems in the dirt. So let's talk a little bit more about that. I mean, given that when people think about Africa, Paul, they're thinking about, you know, this sort of, firstly, they're thinking about 54 countries as one, and then secondly, they're not, you know, despite all the problems that you touched upon, what are you seeing in terms of very promising teams or entrepreneurs in terms of being able to get you compelling returns no matter what the underlying economist numbers are?
So, yeah, Vikram, maybe just a couple of thoughts on that. You know, one of the spaces we're active in is infrastructure. And if you look at the sort of thesis behind infrastructure investment in Africa, you know, anecdotally, you look at Nigeria, where you know, most households in Nigeria even would have a diesel generator because electricity from the grid is so unreliable. Now, you know, grid provided electricity is 1/4 the price of using a diesel generator. So there's a hugely powerful economic opportunity to be providing power into the Nigerian market, and that's true, you know, kind of across Africa. You know, half the people on the planet without access to electricity currently are in Africa, 600 million people. So that's, for instance, one massive big opportunity, and there's a clear economic opportunity because of the cost. Only 25% of roads in sub-Saharan Africa are paved, and it costs 3 to 4 times as much to move goods through a port in Africa and export as it does in Europe. So that's, you know, a massive thing that if you can improve the cost of logistics, port infrastructure, transport infrastructure on the African continent, you can, you know, improve the economic prospects for exports and imports as well, massively. I mean, the last point maybe is just, you know, intra-African trade is sort of in the mid-teens, 15-odd%. So that's trade between countries within Africa, whereas in Europe that's you know, north of 50%. So the opportunity through something like the free trade agreement, which has been set up in Africa, the Africa Free Trade Area now, which has come into place last year, is profound in terms of changing the prospects going forward. So in looking at those, you know, those opportunity sets, if you have investments available that play against those kind of macro themes, and you've got a team that can, you know, execute diligently on that, the economics are clearly apparent. As you identify, Vikram, there's a lot of jurisdictional and other risks in Africa which can, you know, come to play on the thing, but the actual broad margin in terms of what's being attempted to be done commercially is so strong that, as long as some of these side winds can be mitigated over time, there's a clear investment thesis that can be delivered upon. That's a case in point. I mean, another example is maybe agriculture, where our team in that space are looking to identify opportunities for insourcing. So, where a country is importing agricultural produce largely, they'll go and have a look and say, look, why don't we try and set up this value chain in country and produce from the farm gate to delivery to kind of supermarket. And there's the margin is clearly there for it to be done. And the investment thesis is if you kind of invest along the whole value chain, you can ensure that it happens. Historically, the problems have been that you might just be a farmer, but the rest of the value chain fails, so you can't execute. So those are maybe some examples of how you can step up against the opportunity set.
So I'm taking 3 examples here. Growth inefficiencies. The flip side of that is compelling investment opportunities, power, road transportation, and agriculture. And, the kind of returns you could generate from that, people in developed markets would kill for. I'm going to ask Janusz, maybe one place we haven't touched on in this discussion is Latin America, and we also haven't touched on Central Europe. So would you care to, give us some idea about your thoughts on either of those or both of those?
I'm going to just park that for a moment, if I may, depending on how much time, because I think there's a driver which the sectors that Paul had mentioned are all very capex heavy, which as an investor I don't like. What's evident to us, and we debate this a lot in our investment committee now, is technology means something completely different. And I don't mean venture capital, I mean technology. Technology is absolutely integral now. And I go back to my days in Poland, and I remember how, because there was no investment in communication infrastructure, we moved from copper wire to mobile, sort of leaving the middle bit out. And you look in M-Pesa, created in Kenya, as in terms of transferring very cheaply money securely. Emerging markets have traditionally had this opportunity to leapfrog transition. And I think that's one of and technology is about it. Philip Green's empire is falling around his ears as we speak. But when I listen to the news, every comment made by every commentator is his failure to embrace technology and to stay on the high street. And somewhere in there, whatever technology means is part of the opportunity, is to leapfrog from the corner booth to Alibaba. And we've seen in China, huge businesses come out on the back of technology, and more technology businesses being spurned out of it. So that, I think, how technology is used by emerging market companies to make the globe irrelevant will be quite interesting. And I don't mean venture capital. I mean, real businesses. Ventures a completely different question. I think, look, Latin America, Brazil in particular, has a surprisingly large number of really good, experienced GPs. There, it's about currency, bit of politics, really currency and a bit of politics, because the opportunities are there. And it's interesting that a couple of the GPs that historically would have been highly access restricted have found it more difficult in the last cycle to raise money. And that's purely, I would argue, the CNN effect. I think they'll probably do what they... Latin America is somewhere that's been through hyperinflation, political turmoil, etc. There's certain countries you probably might not go into, like Venezuela, but there are others that clearly have talent, experienced managers, and one should look at them. Central Europe for us, the accession countries are Europe for us. We don't think of them as emerging markets. So if we look at a manager in Poland, we would look at them as we would in France or Germany. So the accession countries are clearly the non-accession countries, and Russia is for our investors essentially off the park for the moment for politics. And that doesn't mean there aren't opportunities there for families or foundations that have slightly different noise from their investor group, but for us, it's a problem.
I think there was a former chairman of Citibank in the days, the early Latin America debt crisis, who said, countries don't shut the lights and go away. They continue. So I take your point about the opportunity sets remaining, although not in an institutional format right now. This has all been, it's been a good discussion in the sense where we're all living under the cloud of what's happening in emerging markets and COVID, et cetera. But I think it's helped harness a few important points. There was the, long-term strategic case. There's what we're looking at in terms of the economies being open. There's the CNN noise factor. There's the people and the resilience. There's the opportunity set that exists amid all this distortion and inefficiency, both in the infrastructure area and the technology area. I mean, I'm sitting in India right now where, growing up having a landline was a luxury, and now several people have 3 mobile phones going around. So, and it's nice to have a mobile phone to be able to sort of do your email and things, but also people like fishermen will now know which port to sail to get the better price. And that's, I think, in their little sort of Nokia phones, or the old-fashioned non-smartphones are still giving them valuable text-based information. So this is the point where maybe we check in with the audience and see if there's a response to the polling question. And while that's working, I'll ask Tanya.
Thank you, Vikram. In terms of the polling question, the response to the question is, how confident do you feel about investing in emerging markets today? 0% said extremely. However, 75% said optimistic. 25% is still unsure. Hopefully they're a little bit more sure after this panel. And then 0% said not confident. There is a question that has come through though, and the question is, what has been the silver lining or unexpected positive story in emerging markets in 2020?
Well, panel? Oh, there you go. There's the answer. Ask the dog. It was a bit like the cricket scores, wasn't it? The dog got them right. I think it's very interesting how quickly China has come back. Bearing in mind, whichever number you want to pick, you're talking about number 1 or number 2 economy in the world. That has to be good for the global economy in one way or another. Let's hope it's real, that we're dealing with real numbers, but it does. So I would say it gives us hope that other economies, once we master this COVID in one way or suppress it, can come back. I'm nervous about saying faster than anywhere else, but can come back. I think America has a problem just because COVID has got more rampant than many other countries. And how do you put that genie in the box? But you've got 2 great economies there, which are really important to the global health. And at least one of the engines seems to be firing. So I'd say that's quite a good silver lining.
I think, yeah, I think that's a great observation. I mean, I think the other thing is that, just looking the other day at the top 10 businesses in the US, 7, I think, are new, tech-driven names. And why I was looking at it is that Tesla has just become one of the 10 largest businesses in the US. And obviously Tesla is run by a South African. So I think, what it says to me is that the world is changing increasingly rapidly. And if we look 10 years out, the kind of things that are going to be making the huge running in the investment game over the next 10 years are going to be, I think, space is coming a little bit from left field. So this issue to be, thoughtful about what's happening in emerging markets where some of this kind of thing can be happening, I think is increasingly important for global investors, because I think, more and more likely, there's going to be something interesting coming out of Africa, to quote Pliny the Elder, but not only out of Africa, I think out of emerging markets broadly. So that to me has been, one of the surprises this year, how much has changed actually, and is changing rapidly.
My own take on that is, two areas we've seen, online groceries or hard discount groceries in Latin America, which is an investment of ours, and also telemedicine have been two areas that have got, things were happening in terms of formalization, but they got massively accelerated during the COVID crisis, and those are doing well. And, we hope that sets the example for things even long after COVID's gone, for the kind of pace of change that we expect to see in some of these markets. So is Tanya giving us a signal there? Or
no, we've got a minute left, but another question came in. So either if Paul or Janusz, Vikram, if you can take this one in a very quick space of time, where do you see the best climate action opportunities?
Energy.
who's that?
The big contributor to climate is energy, and we need to re-kit energy systems. So it's from the electric vehicle to how power is produced. We've got to reconfigure, replumb the energy systems globally.
I'll say food, because food waste is the third biggest global emitter of greenhouse gases after the US and China. So if we can solve the food wastage, 50% of food that gets produced doesn't make it to our table, that itself is going to be a huge opportunity.
And I'm going to self-publicize clean energy, of course, because we have a very substantial clean energy business.
Vikram and panel, thank you so much. Really appreciated it. This was a great panel. I wish we had more time because there's lots of questions.